Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for October 27th, 2013. We have a market that is in bullish normal conditions. It's overbought on both an annual and a 10-day basis. Annual, using weekly RSI 14, we're at 71 out of 100. And on the 10-day, using the 10-day NDX at 99 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is white bullish at 9.55%. That gives us about a 7.5% cushion to sideways market condition. The slope of the 50-day moving average has improved to white bullish at 0.49%. ADX is at the high end of neutral at 24. The threshold for that is 25 to become trending up. ATR percentage has declined to under 1% at 0.97, which is in white normal. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, now has tipped over into risk on with a reading of 1.09. If we take that reading of 1.09 and compare it to the last 5,000 trading days, we have a z-score of 1.07, which is very favorable. You can see a 90-day time series of that indicator here, and we bottomed out again at minus 1.5 z. And this has been a good XIV swing trade through this time period here. No change to the blended monthly rebalancing portfolios, which are holding in the 13 and the 22 portfolio. US tech, small caps, and then the Euro Asia blend. And in the ETF 32, it's the European 350 technology, and then the BRIC countries. Next reevaluation will be next week on or about 1 November. The theoretical exposure in ETF 2 is at 100%. The model portfolio will be at 100%. Looking at the current readings of the 13 and the 32 ETFs, it's still technology, small caps, and now it's Australia moving into third place ahead of Euro Asia blend. And then among the 32 ETFs, it is European 350 technology and then US industrials. Looking at the ETF Max, this is from among 1,500 different ETFs using our typical lens. The leaders remain solar energy. Greece is in third position. PowerShares Golden Dragon Index, China Tech, Carbon, China Tech, social media, Global Wind, Spain, etc. See some pretty impressive numbers in here. Greece has been very interesting. If you wanted to weight the 3-month average a little higher. Now we'll look at the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held in the past and which would be price targets on the downside if price collapses from here. We are at a all-time high here in the S&P as it took out the previous swing high here at about 176, and now the what had been resistance levels before 173 and 174 are now support levels. The blue channel is the 10-period RAF regression channel. The center line is the regression line of the 10 days, and then the outer blue channel is the channel formed by the maximum excursion from the regression line during the look back period. So that's sloping up decisively. The black channel is the 30-day channel lagged by 1 day, and we're in the upper half of that channel, and we're also in the upper half of the 90-period regression channel, which is that dark blue line, the dark blue channel. The dark blue shaded area is the 30-period Bollinger Band plus or minus 1. That's the river. Lighter blue shaded area Bollinger, the floodplain is a Bollinger Band 2. This shaded red region is the undercurrent or the dragon. That's a 10 period Bollinger Band plus or minus a half. And so what we have is price riding the outside edge of the floodplain, supported by the dragon, which has come over to the far side of the river, nudging price higher. We saw the last time price was rolling outside the floodplain down here. You can see the dragon had come from one side of the river to the other. When that gets breached, it sets up nice strong moves in the other direction, or supports them, if you will. And then you see this one where price was hugging the outside of the floodplain. That's that regression line stretch, or the Z swing. When the dragon gets breached, goes to the far side of the river, dragon comes down, and now again we're up in this an extended period along the northern edge of the river. This is another nearest neighbor kind of a look back here also. The dragon held support here for a little while. When that fails on the second time, one fail, two fails, then we get those downward moves a little more decisively. You can see that here as well. You get one attempt at support, and it tries to rebound, but then fails, so you get that second leg down. So we haven't really had the penetration of the dragon on the first side yet, so this is still what I would say is early in this extension here, this relief rally after the political shenanigans. And you can see that we're up at the upper edge of that 90-day trend, which has been steep and good. So pullbacks, I would see both of these two red lines holding support and still being within the noise channel. That would not invalidate any of this move here. That's really just coming back to the 30 period mean, supported by the Bollinger Band mean as well. So we've got three strong levels of support that would have to be tested before this bullish leg up is in jeopardy. You can see we're pulling away from the 200 period moving average down here in the red shaded area. This sinusoidal looking line here is the slope value, the time series of the slope of the 30 period regression line, and I've marked off in the blue circles key locations where it got to extremes, and then when that slope crossed the zero line, you can see it got as high as here, crossed the zero line on the way down here. This was the downward sloping max here during this sell-off, crossed the zero line early, comes up here during this period, and now it was on schedule to come down and cross the zero line back here when the market started showing weakness about 8 days ago, but the resolution of the political tension, I think, prompted this little spurt. That was enough to make the 30 period reverse and then start to grow again, and so we really have this much room from the slope to the top of this one really to see how strong this leg up can be. There's no resistance overhead. We're months away from the next government shenanigans, and we're going to have some end of year backing and filling. We've got a Twitter IPO coming up. We've had an extended run in Europe. The emerging markets are starting to come back on the improvement in news in the U.S., I think. And so there's every reason to believe that we can have another leg of this magnitude on the way up after this little consolidation last week. So this is still bull normal. All systems go. And things are looking pretty powerful. The jaws of PPO are still open to the upside after this transition point down here. That's why I like the smoothness of this oscillator, which gave early alerts. Notice how that those jaws open when price crosses to the far side of the dragon. I like the fact that the dragon only came back to the midpoint of the Bollinger Band mean and then reversed to cross higher. We've been oversold now for about 12 days. It can stay oversold for long periods of time. However, we've got measured areas for pullback at 174 and 173. Again, those would not invalidate this move up. So things are looking pretty good. Looking at the ETF2 regional report, all 10 of the regions are above their 4-month moving average, so they're all on buy signals, which puts the model at 100% invested, 0% cash. EFA at 32 is still better than the US at 30, so it's still a global world. Inside the US, the strength is technology at 34, small caps at 33, mid caps 31, and then the US large caps at 30. So that's very much a risk on profile for the US. The two strongest sectors are the European 350, IEV, and technology. The two weakest now are Latin America and EWJ. Latin America coming back into the weakest category there as the S&P moved out of that after flirting for 2 weeks with being one of the weaker sectors. Inside the U.S. sector spiders, it's discretionary, industrials very strong at 34, and materials at 33. So that's a continued shift away from the defensive plays back towards the business as usual and productive end of the economy. Looking at the market health check, everything U.S. is above average except for the Dow, and then you have some growth on the technology and the small cap growth that are exceptionally strong. Asia, less Japan, better than Japan. China and South Korea still remain strong. Everything Europe is above average and some exceptionally so. Brazil and Canada have made a nice rebound along with emerging markets. Inside the other asset classes, treasuries weak, silver and private equity relatively strong. Inside the business sectors, you're now seeing much more parity between the U.S. and the globals as the U.S. has staged this little comeback in the last 7 or 8 days. So not much to choose from there. ETF top 30 reinforces what we do from the blended monthly rebalancing. Solar, Spain, clean energy, Poland, Italy, oil and gas exploration, more Europeans, Germany, and so forth. We would look for things that are earlier in their emerging strength, and so we'd look for strength in the green, followed by consistency in the white. That would be really breakout leaders. So that would give you Germany, oil and gas, the Alpha Dex, South Korea, high beta, the Qs, and then the European stock index. VGK is especially attractive with that over 3 million shares of average daily volume. Looking at the Dow 30 through that same lens, emerging leaders, Microsoft and American Express, green in strength, white in consistency. Still 7 below the well below the market average here in the red. So that'd be a place to start looking for some value plays. You can see United Health has really taken a hit, being yellow on strength and green on consistency, as has Merck, red on strength, white on consistency. Just some reference data. We'll shift now to the daily. Let's see, we have channeling signals in Japan and United Health. We have a channeling signal in emerging markets. 551Ws and blended commodities in emerging markets. Caterpillar and JP Morgan, 551Ws. The auto framer giving us signals where reward to risk is better than 2 to 1 for the VIX, United Health, oil, Caterpillar, IBM. Brazil, emerging markets, Asia less Japan, and JP Morgan. In the Dow tactical summary, nothing fired on the RSI2. We have plenty of very froggable candidates. The percent loser Friday was Procter & Gamble, but big winners in Microsoft, American Express, and Intel, which have been very, very strong. Max pain range compression, if we have United Health at a 7.3 reward to risk ratio, it's down almost 10% over the last 10 days. That's a potential rebound from a value proposition. And it is both a doji, channeling, and an overreaction. So that could be one that could be very well framed. IBM at 2.7 to 1, Caterpillar 3.4 to 1, Morgan at 2.0, and that's all. That and Caterpillar are both 551Ws. Looking at the ETFs, a handful of dojis, one channeling in Japan, 551Ws in blended commodities and emerging markets, 8 to 1 in the VIX, 4 to 1 in oil, 2.2 to 1 in emerging markets. The big winners Friday: oil, utilities, real estate, the big losers, EFA, silver, Japan, and the VIX. Some auto framer key numbers for you. Looking at market mosaic stats, chart 1, the 30 period regression line in blue, the polynomial regression in black, definitely pointing to an accelerated upward move. You can see that the slope of that 30 over the last 180 days has changed and crossed higher. It's crossed its own 10 period moving average, crossed higher right at the 6-month average. This has been a measured move, I would say, a 2 standard deviation move up for price relative to the 200. That's sort of the upper channel of what these normal oscillations have been. So we've got to see another leg up. But if we do, there's certainly another 5 to 6% just to get back up to retest previous highs. Volatility is right at 6-month average prices by both measures that we use. And the rest of this is some reference data. XLP has made a nice stealth recovery move, as has Alcoa. Microsoft looking strong here. These are based on the Z-scores of how much these things have been gaining over the last 5 days, 10 days, 20 days, and 40 days. It gives you the relative Z-scores compared to their own performances. So there's been a broad-based strength here in the spiders and technology, small caps, Euro Asia. Alcoa is most fully manifested here. Looking at the Z-scores of the regression line slopes for the market compared to that yellow zone of plus or minus 1. We have the 90 in the red on the upswing. The 30 has made a rebound at the 6-month average and rolling up, so there's still room for that to go. The 10 had made a 2.5 Z move, is pulled back, but is still exceptionally strong outside the river. And when we look now with price with respect to the river, you can see that we have been finding support at the southern boundary of the river, crossed, and this has been an extended move up here, although the last time we've done that led to an unsustainable price level, which came back almost 10 points from 165 down to 155. So that would lead us from about 175 to 165, which would still be within the normal oscillation of the market, provided that the southern edge of the river has holds support. But just notice that the volatility has been expanding. The jaws of the dragon are open. I would expect it, as we saw in the health check, to find support at the edge of the river, or at least the Bollinger Band mean, for this really to be the start of something really, really good. The SPY, small caps, everything looking good. Treasuries have actually started to reverse and make a nice little rebound here, forming the bottom half of their cup and saucer, or cup and handle. And gold made a slight bounce off technical support at 120. And this is some frog stats. And that's everything I want to cover for today. And we'll see you in the chat room and on the webinar tonight. So keep your powder dry and your risk measured.